I-record, record, i-record. Basta hindi na-record. Financial risk is the risk of a possible future change in one or more of a specified interest rate, financial instrument price, commodity price, foreign exchange rate, index of prices or rates, credit rating or credit index, or other variables, provided in the case of a non-financial variable that the variable is not specific to a party to the contract. Financial risk includes the following. Financial risk includes the following: credit risk, the risk that one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. Number two, liquidity risk is the risk that an entity will encounter difficulty in meeting obligations associated with financial liabilities that are settled by delivering cash or another financial asset. Market risk, the risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in the market prices. Market risk comprises three types of risk. A. Interest rate risk, the risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in market interest rates. B. Currency risk, the risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in foreign exchange rates. Other price risk, the risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in market prices other than those arising from interest rate risk or currency risk, whether those changes are caused by factors specific to the individual financial instrument or its issuer, or factors affecting all similar financial instruments traded in the market. Okay? As we know that derivative accounting is becoming more and more important. Some companies even employ accountants whose sole responsibility is to account for derivative transactions entered into by the company. The audit profession regards derivative transactions as risk areas. Every year, audit firms and entities with internal audit activity devote more and more resources to audits of derivatives. In other words, accounting for derivatives is here to stay and it won't go away. As future CPAs, you are left with no choice but to diligently study and learn study derivatives. Okay? Now, we also have to understand the common types of derivatives. One, forward contract. Forward contract is an agreement between two parties to exchange a specified amount of a commodity, security, or foreign currency at a specified date in the future at a pre-agreed price. Simply stated, a forward contract is a contract to buy or sell a commodity, security, or foreign currency at a specified amount or quantity at a specified future date and at a price which is agreed now. So that's in connection with a forward contract. A future contract is a contract traded on an exchange that allows an entity to buy or sell a specified quantity of commodity or a financial security at a specified price on a specified future date. Now we are going to compare forward contract with futures contract. So we have two columns. We have two columns here. First column label forward contract. Second column future contract. So first column forward contract. Second column future contract. Forward contract number one, they are private contracts which are most likely over-the-counter transactions. Forward 1. They are private contracts which are most likely over-the-counter transactions, while future contracts are traded in a market. 1. Traded in a market. 2. Forward are customized contracts. Under forward, number two are customized contracts. Under future, number two are standardized contracts. Number three, forward are private contracts between two private parties who interact directly with each other. That's under forward. Are private contracts between two private parties who interact directly with each other. Under future contract, future. A party in a future contract may never know the other contracting party because they interact indirectly through a broker. A party in a future contract may never know the other contracting party because they interact indirectly through a broker. 4. Under forward may be settled by the actual delivery of the agreed upon commodity or net cash payment. And under futures are normally settled through net cash payment. Are settled, normally settled, and through net cash payment. So, these are the distinguishing features between forward contract and future contract as common types of derivatives. Now, in addition to forward contract and future contract as types of derivatives, number three is option. That's another derivative, option. Option is a contract giving the holder the right but not the obligation to buy or sell an asset at a specified price anytime during a specified period in the future. When the holder exercises his right, the writer of the option is obligated to perform his obligation on the option contract. The significant difference between a future and an option is that the option provides the holder only an option, not an obligation, to buy or sell a financial instrument or security at a pre-agreed price called the strike price. Strike, STRIKA. The option buyer will exercise the option only when the option is in the money. That is, the buyer gains in exercising the option. We have types of options as to exercise date. So the types of options as to exercise date. Number 1, European options. European options can be exercised only at expiration time. European options can be exercised only at expiration time. Number 2, American options can be exercised anytime prior to maturity. American options can be exercised anytime prior to maturity. And the last one is Bermudan options. Bermudan options can be exercised prior to maturity but on certain predetermined dates. So we have now European, American, and Bermudan options. These are the types of options as to exercise date. As to exercise date. Then we have the types of options as to right of holder. The types of options as to right of holder. Letter A, or number 1, call option, an option to buy. And letter B, put option, PUT, an option to sell. So we have call option and put option. Call option is the option to buy, while put option is the option to sell. Now, we have, will you have 4 columns with the following headings? First column, type of option. Second column, strike price equals market price. Second column, strike price equals market price. Third column, strike price is less than the market price. Strike price is less than the market price. And last column, strike price is greater than the market price. So strike price is greater than the market price. So line number 1, call. Type of option is call or buy. Strike price equals market price. 1 at the money. At the money. Third column, strike price is less than the market price. Call is in the money. And last column, out of the money. I'll repeat. Number 1, option is call or buy. Second column, at the money. Third column, in the money. Fourth column, out of the money. And number 2, put or sell. Put or sell. Second column, at the money. Third column, out of the money. And fourth column, in the money. Okay. At the money means that the holder may or may not exercise option. No gain or loss in exercising. So what we mean by at the money? Meaning the holder may or may not exercise the option. No gain or loss in exercising. In the money means that the holder should exercise. There will be gain in exercising. In the money means the holder should exercise the gain. Should exercise. There is gain in exercising. And out of the money means the holder should not exercise. Out of the money means that the holder should not exercise. There will be loss in exercising. There will be loss in exercising. Now let's have an example. example. You purchased a call option from Mr. X. You purchased a call option from Mr. X. The option gives you the right to buy banana for 5 pesos. You purchase a call option from Mr. X. The option gives you the right to buy banana for 5 pesos. 5 pesos is the strike price or the exercise price. So, 5 pesos is the strike price or exercise price. Now, for this example, let's have case number 1. Case number 1. At exercise date, banana costs 12 pesos. At exercise date, banana costs 12 pesos at 7-Eleven. At exercise date, banana costs 12 pesos at 7-Eleven. The option is in the money. The option is in the money. You will save 7 pesos by buying from Mr. X. The option is in the money. You will save 7 pesos by buying from Mr. X. You'll save because if you'll buy from 7-Eleven, it's 12. If you'll buy from X, only 5. So that's in case number 1. In case number 2, at exercise date, banana costs 3 pesos at 7-Eleven. In case number 2, at exercise date, banana costs 3 pesos at 7-Eleven. The option is out of the money. You are better off buying banana at 7-Eleven than from Mr. X. So in case number 2, at exercise date, when the banana costs 3 pesos at 7-Eleven, the option is out of the money. You are better off buying banana at 7-Eleven than from Mr. X. So that's out of the money. Meaning, out of the money, the strike price is greater than the market price. So you have out of the money. That's example number 1. Let's go to example number 2. You purchased a put option, put, P-U-T. You purchased a put option from Miss A. You purchased a put option from Miss A. The option gives you the right to sell. The option gives you the right to sell a monkey for 1,000. The option gives you the right to sell a monkey for 1,000. Case number 1. At exercise date, the monkey is being sold for 800 at store M. At store M. At exercise date, the monkey is being sold at 800 pesos at store M. The option is in the money. You'll gain 200 from selling monkey to Mr. or to Miss A. The option is in the money. You'll gain 200 from selling monkey to Miss A. Case number 2, at exercise date, monkey is being sold for 1,500 at store M. The option is out of the money. You are better off selling monkey to or at store M. The option is out of the money. You are better off selling monkey to store M. Like the other derivatives, options may also be settled through net cash payment. Like in example 2, in case number 1, the option is in the money. However, you don't actually own a monkey to sell. You settle the option. Miss A pays you the net difference of 200 pesos. If the option is out of the money, no cash settlement is required, since the option gives you a right, not an obligation. You will treat the acquisition cost of the option as a loss. Miss A will treat it as a gain. Okay, we are still talking about the types of derivatives. Number 1 is forward contract. Number 2, futures contract. Number 3, option. Number 4, swap. Number 4, swap. Swap is a contract in which two parties agree to exchange payments in the future based on the movement of some agreed upon price or rate. Common examples are interest rate swap. It's a contract between two parties who agree to exchange future interest payments on a given loan amount. Usually one set of interest payments is based on a fixed interest rate and the other is based on a variable interest rate. So under swap, number 1 is interest rate swap. Number 2 is foreign currency swap. Is a contract between two parties who agree to exchange sum of money in one currency for another currency. Okay? So number 4 type of derivatives is swap. Next, number 5, another type of derivative is caps, C-A-P-S. C-A-P-S. Floors, Floors, and collars, Collars, are essentially options designed to shift the risk of an upward and or downward movement in variables such as interest rates. These are normally linked to a notional amount and a reference rate. For example, if an entity wants to transfer the risk of interest rates going up, the entity will enter into a cap on a notional amount of, say, 100 million with the interest rate of 5.5%. Now, if the interest rate increases to 6%, the cap holder will be able to claim as settlement from the cap seller for the differential rate of 0.5% on the notional amount. If the interest rate does not go up or rather declines, the option holder would have paid the premium and there is no settlement. On the other hand, if an entity expects the interest rate to go down, which spells a risk to him, the entity would enter into a floor which would allow him to claim as settlement if the interest rate falls below a particular strike rate. Interest rate collar is the fixation of both a cap and floor so that the payment will be triggered if the rate goes above the collar and below the floor. Caps, floors, and collars differ from interest rate swap since under caps, floors, and collars, the other contracting party does not necessarily have a variable or fixed interest rate loan. Now we go to number 6, type of derivatives. It's swaption. Swaption, 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 is an option on a swap. The option provides the holder with the right to enter into a swap at a specified future date at specified terms. This derivative has characteristics of an option and a swap. And the last is weather derivative. Weather, WEATHER. A contract that requires payment based on climatic, geological, or other physical variables. Okay, now we go to measurement of derivatives. Measurement of derivatives. All derivatives are measured at fair value. The accounting for fair value changes depends on whether the derivative is, number one, not designated as a hedging instrument, and number two, designated as fair value hedge. Number three, designated as cash flow hedge. Now, in the lecture in the canvas, you have your cash flow heads and your fair value heads. In number one, when there is no hedging designation, derivatives not designated as hedging instrument are considered as obtained for speculation about the direction of movement of some price, rate, or any underlying. These are accounted for as held for trading securities. Accordingly, fair value changes are recognized in profit or loss. The accounting for held for trading securities is, we have already discussed this in financial accounting part 1. Number 2, measurement of derivatives. We have number 2 and 3, we have hedges. Hedges. Hedging means designating one or more hedging instruments so that their change in fair values or cash flows offset in whole or in part the change in the fair value or cash flows of the hedge item. Now we have the components in a hedging relationship. Number 1, we have the hedging instrument, a designated derivative or a designated non-derivative financial asset or financial liability whose fair value or cash flows are expected to offset changes in the fair value or cash flows of a designated hedge item. Number 2, hedge item. Number 1 is hedging instrument. Number 2 is hedge item. An asset, liability, firm commitment, highly probable forecast transaction, or net investment in a foreign operation that exposes the entity to risk of changes in the value of future cash flows and is designated as being hedged. Now, with regards to hedging instrument, generally there are no restrictions on the circumstances in which a derivative may be designated as hedging instrument for as long as they meet the conditions for hedge accounting. Only instruments that involve external parties can be designated as hedging instruments. Hedging transactions between related parties are eliminated in the consolidated financial statements, but may not be presented in the entity's separate financial statements. Designation of hedging instruments. Hedging instruments are designated in their entirety. However, the following are permitted. 1. Separating the intrinsic value and time value of an option contract and designating as the hedging instrument only the change in intrinsic value. The change in time value is excluded. Letter B. Number 2, separating the interest element and the spot price of a forward contract. These exceptions are permitted because the intrinsic value of the option and the premium on the forward can generally be measured separately. A dynamic hedging strategy that assesses both the intrinsic value and time value of an option contract can qualify for hedge accounting. Samples of dynamic hedging strategies. A. Delta neutral hedging strategy. Delta neutral hedging strategy. The quantity of the hedging instrument is constantly adjusted in order to maintain a desired hedge ratio. For example, to achieve a delta neutral position insensitive to changes in the fair value of the hedge item. Letter B, macro hedging. Hedge of interest rate risk on a portfolio basis wherein actual fair value hedging is often conducted by acquiring a hedging position to protect against the effect of the value changes of the net asset or liability position maintained. Designating only a portion of a hedging instrument, such as 50% of the notional amount, is permitted. However, a hedging relationship may not be designated for only a portion of the time period during which a hedging instrument remains outstanding. Designating a single instrument for more than one type of risk is provided, no? A single hedging instrument may be designated as a hedge of more than one type of risk, provided that A, the risk hedge can be identified clearly. B, the effectiveness of the hedge can be demonstrated, and it's possible, letter C, it is possible to ensure that there is specific designation of the hedging instrument and different risk positions. Hedge effectiveness is the degree to which changes in the fair value of cash flows of the hedge item that are attributable to hedge risk are offset by changes in the fair value of cash flows of the hedging instrument. And designating a combination of instruments, two or more instruments or proportions of them may be jointly designated as a hedging instrument. However, an instrument that combines a written option and a purchase option does not qualify as a hedging instrument if it is in effect a net written a net written option. Now we go to hedged items. A hedged item can be, letter A, recognized asset or liability. So like recorded receivables or payables. B, unrecognized firm commitment. Unrecognized firm commitment, such as receivable not yet recorded on a future sale commitment or payable not yet recorded on a future purchase commitment. C. Highly probable forecast transaction. Highly probable forecast transaction, or a planned but not committed future sale or future purchase. The girly stuff you want to purchase. And D, net investment in a foreign operation like a foreign subsidiary. So for the heads items, A, recognized asset or liability. B, unrecognized firm commitment. C, highly probable forecast operation. And D, net investment. A hedge item can also be a group of any of the items listed above that share similar risk characteristics, or only an option of an item listed above. So we have examples of these hedge items. One, firm commitment, forecast transaction, foreign operation, or net investment in a foreign operation. Firm commitment, forecast transaction, foreign operation, and net investment in a foreign operation. Only items or transactions that involve external parties can be designated as hedge items. Those that involve related parties are eliminated in the consolidated financial statements but may be presented in the separate or individual financial statements. However, the foreign currency risk of an intra-group monetary item, such as a payable or a receivable between two subsidiaries, may qualify as a hedge item in the consolidated financial statements when it results in an exposure to foreign exchange rate gains or losses that are not fully eliminated on consolidation in accordance with PES 21, the effects of changes in foreign exchange rates. This is the case when the intra-group monetary item is transacted between two group entities that have different functional currencies. In addition, the foreign currency risk of a highly probable forecast intra-group transaction may qualify as a hedge item in consolidated financial statements, provided that the transaction is denominated in a currency other than the functional currency of the entity entering into the transaction, and the foreign currency risk will affect consolidated profit or loss. Now, how about hedge accounting? Hedge accounting recognizes the offsetting effects on profit or loss of changes in the fair values of the hedging instrument and the hedge item. Conditions for hedge accounting. So what are now the conditions for hedge accounting? Okay, if all of the following conditions are met, then your hedging relationship qualifies for hedge accounting. If all of the following conditions are met. A. At the inception of the hedge, there is a formal designation and documentation of the hedging relationship and the entity's risk management objective and strategy for undertaking the hedge. The documentation shall include the identification of following: the hedging instrument, the hedge item or transaction, the nature of the risk being hedged, and how the entity will assess the hedging instrument's effectiveness in offsetting the exposure to changes in the hedge item's fair value or cash flows attributable to the hedged risk. So hedge accounting is allowed if all of the following conditions are met. So we have 5 conditions. And letter A is, at the inception of the hedge, there is a formal designation and documentation of the hedging relationship and the entity's risk management objective and strategy. Letter B, the hedge is expected to be highly effective. The hedge is expected to be highly effective. It means that on initial accounting, the high effectiveness of hedge relationship is only an expectation. The entity does not need to prove on initial accounting that the relationship is actually highly effective. Such can be demonstrated in various ways, such as past experiences with similar instruments or based on other observable data. Subsequently, a hedge is considered highly effective if all the actual results of the hedge are within a range of 80% to 125%. If actual results fall beyond the range, the hedge is deemed not highly effective. So in connection with the second condition for hedge accounting, the hedge is expected to be highly effective, and it's only considered to be highly effective if actual results of the hedge are within a range of 80% to 125%. Sample, if actual results are such that the loss on the hedging instrument is 120 and the gain on the cash instrument is 100, offset can be measured by 120 over 100, which is 120%, or by 100 over 120, which is 83%. In this case, the entity would conclude that the hedge has been highly effective. Okay? Effectiveness is assessed at a minimum at the time an entity prepares its annual or interim financial statements. There is no required single method of assessing hedge effectiveness. An entity should use its own risk management strategy in determining hedge effectiveness. To qualify for hedge accounting, the hedge must relate to a specific identified and designated risk and not merely to general business risk. And the risk must ultimately affect the entity's profit or loss. For example, a hedge of the risk of obsolescence of a physical asset or the risk of expropriation of property by a government is not eligible for hedge accounting. Effectiveness cannot be measured because those risks cannot be measured reliably. If an entity does not meet hedge effectiveness criteria, the entity discontinues hedge accounting prospectively from the last date on which compliance with hedge effectiveness was demonstrated. C. It's still another condition for hedge accounting. For cash flow hedges, the hedge forecast transaction must be highly probable and must present an exposure to variations in cash flows that could ultimately affect profit or loss. Letter D, the effectiveness of the hedge can be reliably measured. Letter E, the hedge is assessed on an ongoing basis and determined to actually have been highly effective throughout the financial reporting periods for which the hedge was designated. Now we go to hedging relationships are of three types. One, fair value hedge. Two, cash flow hedge. And three, hedge of a net investment in a foreign operation. Fair value hedge is a hedge of the exposure to changes in fair value of a recognized asset or liability or an unrecognized firm commitment that is attributable to a particular risk and could affect profit or loss. A fair value hedge is accounted for as follows. A. The gain or loss from remeasuring the hedging instrument at fair value shall be recognized in profit or loss. And the gain or loss on the hedge item shall adjust the carrying amount of the hedge item and recognized in profit or loss. This applies even if the hedge item is measured at cost. Now, discontinuance of fair value hedges. An entity shall discontinue prospectively a fair value hedge accounting if A. The hedging instrument expires or is sold, terminated, or exercised, except when rolled over in accordance with entity's risk management strategy. B. The hedge no longer meets the conditions for hedge accounting. And C. The entity revokes the designation. Now, these are the very important things to remember in connection with fair value hedge. Now, the third one is, or the second one is cash flow hedges. Cash flow hedge is a hedge of the exposure to variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability, or a highly probable forecast transaction and could affect profit or loss. A cash flow hedge is accounted for as follows. Letter A. The portion of the gain or loss on the hedging instrument that is determined to be an effective hedge shall be recognized in other comprehensive income, and the ineffective portion of the gain or loss on the hedging instrument shall be recognized in profit or loss. Discontinuance of cash flow hedges. An entity shall discontinue prospectively cash flow hedge accounting in any of the following circumstances. A. The hedging instrument expires or is sold, terminated, or exercised, except when rolled over in accordance with entity's risk management strategy. B. The hedge no longer meets the criteria for flow hedge accounting. C. In cases of A and B above, the cumulative gain or loss on the hedging instrument that has been recognized in other comprehensive income from the period when the hedge was effective shall remain separately in equity until the forecast transaction occurs. When the transaction occurs, the cumulative gain or loss is: number one, transferred to profit or loss as a reclassification adjustment if the forecast transaction resulted to recognition of financial assets or liabilities. And number two, transferred to profit or loss as a reclassification adjustment or removed from equity and included in the initial cost of an asset or liability as a matter of accounting policy. In this case, to be removed from equity and included in the initial cost of an asset or liability if the forecast transaction resulted to recognition of non-financial assets or liabilities. And still part of this continuance of cash flow hedges, letter D, the forecast transaction is no longer expected to occur. In this case, any related cumulative gain or loss on the hedging instrument that has been recognized in other comprehensive income from the period when the hedge was effective shall be reclassified from equity to profit or loss as a reclassification adjustment. A forecast transaction that is no longer highly probable may still be expected to occur. And letter E, the entity revokes the designation. Okay, now in number 3, we have the third type of hedging relationship. Number 1, fair value hedge. Number 2, cash flow hedge. And number 3, hedge of a net investment in a foreign operation. Accounted for similarly to that of cash flow hedges accordingly. Letter A, the portion of the gain or loss on the hedging instrument that is determined to be an effective hedge shall be recognized in other comprehensive income. And letter B, The ineffective portion shall be recognized in profit or loss. The gain or loss on the hedging instrument relating to the effective portion of the hedge that has been recognized in other comprehensive income shall be reclassified from equity to profit or loss as a reclassification adjustment on the disposal or partial disposal of the foreign operation. Now let's try to remember the following as a summary. Column 1, type of hedge. Column 2, accounting for changes in fair values of hedging instrument or derivative. In column 1, type of hedge. Number 1, no hedging designation, meaning it's only for speculation. No hedging designation, it's only for speculation. So under accounting for changes, in number 1, in line with number 1, profit or loss. Profit or loss. In number 2, under the fair value hedge, column 2, profit or loss. Number 3, cash flow hedge, letter A, for the effective portion under accounting for changes, letter A, other comprehensive income. And letter B, ineffective portion, letter B, profit or loss. And number 4, hedge of a net investment in a foreign operation. Letter A, effective portion under accounting. A, other comprehensive income. A. And B, for the ineffective portion, B, profit or loss. Now, we go to the type, column 1, type of hedge item. Column 1, type of hedge item. Column 2, type of hedge. So column 1, type of hedge item. Column 2, type of hedge. Under type of hedge item, number 1, recognized asset or liability. Under type of hedge, fair value or cash flow hedge. That's the type of hedge. Fair value or cash flow hedge. Now, number 2, under type of hedge item. Under number 2, unrecognized firm commitment. Unrecognized firm commitment. Under column 2, fair value hedge, except for a hedge of the foreign currency risk of a firm commitment which may be accounted for as a fair value hedge or a cash flow hedge. So 1 and 2. Then we go to number 3. Under type of hedge item, number 3, highly probable forecast transaction. Highly probable forecast transaction. So the type of hedge is cash flow hedge. And number 4, net investment in foreign operation. Net investment in foreign operation. The type of hedge is cash flow hedge. Cash flow hedge. So these are the very important notes that you need to consider in accounting for derivatives and for hedges. Now, I will include this in the theory for module number 21. So in other words, module 21 is only for theory. Okay? So again, let me announce that the final exam will be given on November 12 at 10 o'clock up to 1 o'clock. And the theory will include modules 17 to 21, while the problems will only include chapters or module 17 up to 20. Okay? And again, some of you who missed some exercises and long exams, now I will post your names in the canvas, and your special exam date will be on Saturday. That will be November 14. Okay? November 14. And the time is stated already at 10 o'clock in the morning. Okay? So God bless everyone, and hoping to see you in person soon. Okay? So thank you very much. Thank you for the time that we have shared. Thank you for the cooperation, for the patience, and the perseverance. Now, I always include in my prayer that someday you will become certified public accountants. Okay? So, thank you again. Yes, yes.